Inflation is apparently low and declining. The economy is still strong. You know, in that sort of environment, gold is not the asset of choice. Now, I think that's shifting as more and more people see that, you know, either they see from, well, more and more people are beginning to see that the economy is slowing, and the unemployment rate going up in the US 4 months in a row is one thing. And of course, the most important thing is Jerome Powell's speech on Friday at Jackson Hole, where he said the time has come to change policy, to shift policy. So the expectation is for an interest rate cut next month. And typically when the Fed first cuts interest rates, you see gold, gain traction. So I think over the next month, we're going to see more and more individuals and retail start moving into the gold space. Well, in very broad strokes, I mean, first of all, the US economy, to me, I won't keep saying to me, I'll just say, you know, the US economy is clearly slowing. I mean, manufacturing's been weak for a while, but other parts of the economy are slowing as well. And in my view, particularly the unemployment, the labor picture is nowhere near as strong as even it looks today, if you just look at the headline numbers, but certainly nowhere near as strong as it looked last week before that absolutely outrageous jobs revision from the Bureau of Labor Statistics. Anyway, we can talk about the labor picture, the employment picture if you want, but I think it's a lot worse than it appears. That's one thing. But consumer, I don't think, is anywhere near as strong as the headlines would suggest. Consumer spending is up, but if you look under the hood and look at the patterns, it's not that strong at all. Clearly, there's a bifurcated economy. The bottom half, or even bottom 60 or 70%, are struggling in various degrees. And so that's hidden by the aggregate numbers. So that's one broad stroke. I think the other thing is, you know, if we look at markets, you know, it strikes me that most developed markets around the world are overvalued and vulnerable. So in this business, I think it's important that if you're managing money, what's important is not that you make predictions that turn out to be right. What's important is that you assess risk and reward and capitalize on the reward or potential and try to minimize the risk. So in terms of risk reward, the major developed markets around the world, other than Japan and China, appear to me to be very vulnerable right now, particularly the stocks that have led. So in the US, that would be the big cap tech stocks that have led. Extremely vulnerable right now. I think what we've got to do is look at who's been buying gold and why have they been buying gold. And for the last 18 months and virtually all of this year, the number one buyer of gold has been central banks. Well, central banks are trying to diversify their assets away from the dollar and avoid the weaponization of the dollar. Gold is a traditional central bank asset. But the central bank of Uzbekistan or of China, for that matter, or Germany or anywhere else, you know, they're going to buy physical gold. They're not going to buy drums of uranium. For their central bank reserves. They're not going to buy uranium, as perhaps a bad example, because uranium has done well. I mean, we can talk about that later, but they're going to buy gold and virtually to the exclusion of everything else. They're certainly not going to be buying Newmont or Barrick if they're trying to, you know, get away from the weaponization of the dollar. The number two buyer of gold in the last 6 months has been Chinese investors who are, again, anxious about the banking system in China, anxious about the depreciation in the yuan and the slowdown in the economy there. They want to take the money out of banks because the banking system is seen as not safe. They don't want to put it into equities, but have declined, 40%? They've just slid and slid and slid for the last year and a half, 2 years. If you're looking to protect your assets, you don't go there. They're not allowed to buy crypto. So gold, which has been a historic store of value in China for Chinese people, is the natural place where they turn. Again, a Chinese investor trying to protect himself against a slowdown in that economy and the depreciation of the yuan is not going to start picking up North American gold stocks. I mean, typically Chinese investors don't buy a lot of gold equities anyway, but particularly North American gold stocks. And so if you look at who's buying and why they're buying, it makes absolute sense that most of the money has been going into gold, physical gold, not into silver, not into gold stocks, not into other commodities. That all makes sense. And of course, as we all know, gold and silver are monetary metals. Silver also has industrial, but that is still a monetary metal. And the other metals are not. So they do react, even though they frequently move at the same time, because some factors, like the dollar, for example, the level of interest rates, for example, inflation, those things will have a similar effect on all commodities. But then there are other factors that will be positive for gold that don't affect other commodities. And there'll be other factors, primarily, of course, the state of the global economy, that will affect commodities, but not necessarily affect gold and silver. And we know that. We have been beginning to see a little bit of movement from, and I'll break it down, from Western investors generally, because for Western investors, North America and Europe have actually been net sellers of gold up until very, very recently, and net sellers on a consistent basis, pretty much all year. What we've been seeing in the last 4-6 weeks, we've started to see some pretty large OTC trades in London, and you don't see those trades reported individually, but you see the aggregate. And the suspicion is, and anecdotally they seem to be large trades, the suspicion is that there are a relative few very wealthy families, maybe institutions, but families and individuals who are wanting to get into gold. There is still no broad rush by what we'll call individual or retail investors to move into gold. And you can see that in coins. You know more about that than I do, but the coin dealers I talk to say, yes, there's been a little bit of a shift, but certainly no large wholesale rush into buying physical. And earlier in the year, some of my coin dealer friends were telling me they were getting more people who called were wanting to sell their gold than actually buy it. You look at the gold ETFs as well, GLD. For the last month, we've had a little bit more on the inflow, but still pretty balanced between inflows and outflows. And up until this month, up until August, it's been pretty much consistent selling. 3 or 4 days of selling for every 1 day of buying. That's beginning to shift, though, as I say, it's beginning to shift. So we're now seeing maybe 2 days of 3 days of buying for every 2 days of outflows from the GLD. Just beginning to shift. I think the macroeconomic environment in the US and North America generally is not a positive. If you just took a snapshot, it's not really a positive environment for buying physical gold. Yes, the dollar's come down, but interest rates are still high. Inflation is apparently low and declining. The economy is still strong. In that sort of environment, gold is not the asset of choice. Now, I think that's shifting as more and more people see that, either they see from, more and more people are beginning to see that the economy is slowing, and the unemployment rate going up in the US 4 months in a row is one thing. And of course, the most important thing is Jerome Powell's speech on Friday at Jackson Hole, where he said the time has come to change policy, to shift policy. So the expectation is for an interest rate cut next month. And typically when the Fed first cuts interest rates, you see gold, gain traction. So I think over the next month, we're going to see more and more individuals and retail start moving into the gold space.